Good morning, everyone. Welcome to another Wealth Coffee Chat. Hopefully you're all awesome and well. Most of you had a long weekend, I think, anyway. Most of us had a long weekend. Some Queensland didn't, but the rest of us did. Anyway, I'm in Queensland. I kind of quasi-participated, did a bit of work, but didn't. Morning, folks. I hope you're well. Morning to you, Aaron. We've got Chris there. Someone behind the veil, the Facebook veil. Good morning, whoever that is. Great to see all of you online this morning as things warm up. We'll get the show on the road. We'll do the little intros as we normally do. Jason Witten's my name. If you didn't already know, most of you do. But if you knew, you might have joined our coaching and mentoring program of recent times. Give us a little shout out. Say a little hello in the chat. Let us know where you're coming in from. What are you up to? Great to have you here live this morning. What do we do each morning? Around about 10 past 8, we have a Wealth Coffee Chat. That's what we do. Usually Monday to Friday, normal hours. And, we try to dive into some information, some fear from facts, some stuff that keeps us going as property investors. So there you go, folks. That's what we get up to. If you're new, if you're a repeat attendee, welcome back. If you're new, welcome for the first time or whatever that might be. Chris is all the way from Cairns. Morning, Chris. Good to see you. Good to see you. There you go. I thought I had some questions the other day about structures, about how we own properties, and do I need structures, company and trust structures to own properties for one reason or another. So I thought I might sort of talk about that this morning. Mick, how are you, mate? Great to see you. Thanks for joining. We need to catch up sometime soon, Mick. I'm sure the team will organise that. Luke, morning to you. How are you, mate? So let's talk about structures. Let's talk about how we own properties, the ins and outs of that. We'll do a bit of an overview today. So maybe while you're sitting there thinking, pontificating, what reasons have you heard that you might need structures? Because there's usually one reason I hear most property investors say, oh, do I need structures? Do I need to, own my properties in something other than my own name? Tell me in the chat, what have you guys heard about ownership of properties? Because, sometimes we hear things from reputable people. Yep, Luke's on that. Asset protection. Usually that's the most asset protection and risk management. Yeah, exactly, Sharon. So those things are very poignant but we have to weigh up as property investors the reason for them. So we're going to go through that today. And the other one, absolutely, income and trust distribution. Yeah. That is true, Chris. That is true. So let's talk about that today, folks. Let's have a little chat about structures and, what is going on. Kels, brother. I was thinking about you the other day, Kels. I was going to give you a call, but didn't get around to it, and you found me. Anyway, there you go. I hope you're well, brother. Give us, anyway, let's chat sometime soon. All right, let's get on with this morning. Ownership. How do we own properties, and what's the drill? What's the go? Well, there's a few things we need to sort of consider, right? There's a few things we need to consider as investors in real estate, and there's really two ways. There's really two ways to own real estate in general, right? There's two ways. And what are those two ways? Well, the first way, now I'll try and do some drawings. There's the first way, and terrible drawing, by the way. Terrible drawings, by the way. Is you can own those properties as an individual, okay, in your own names. Now, there's a couple of different ways to do that, all right? There's a couple of different ways to do that, and there's pros and cons to that. We'll go through that in a second. And then the other way is, yep, dead right, Tim. Oh, we've got a bit of a spammer here. Let me get rid of this spammer, all right? Yeah. All right. There we go. Sometimes you get them sneaking up in your lives. Anyway. All right. So Tim is onto it. You can in your own name. You're dead right, Tim, or in a company trust structure, a structure of some description, right? Some structure. Now structures can be quite varied, but usually they come in the form of a company or a company trust of some description, and so on. There's various names, but really it's the company or a trust. Like that's the way it is. So what are the pros and cons of these? Let's have a bit of a look at what that might be and how we can tune it up as property investors and really sort of cut through a bit of the muck when it comes to this stuff, folks, as we go. So let's have a look at sort of some of the things that we could own real estate in when it comes to structures, and then we'll go back to our personal names. Now, what are we looking for as investors? Well, we're looking for tax effectiveness. We want to make sure we can distribute, income, capital gains, minimize our taxes, and there's lots of different things in here. There's asset protection. Now, what are we trying to protect from? Let's talk about that in a minute, okay? Because, what we think we're protecting from, and what we are protecting from is, something a bit more interesting. And then, estate planning and succession, so in the beginning, you want your structures, how you own things, to be tax effective and protect your assets. And then later on, you want to be able to, pass those assets on. Maybe you don't. Maybe you want to spend it all and have a good time while you're here. Maybe you want to be able to pass it on to, your children, your family, charities, et cetera, in the future. Now, the challenge, if you can see this little matrix, is that there is, lots of yeses and nos, right? All at different places. And the challenge, folks, is this. There is not one perfect structure or one ownership structure for property, by the way, for real estate, that is perfect for the whole time. And that is a pain in the butt when it comes to that stuff. So let's talk about that. Let's talk about the pros and cons as we go in ownership. There's two major things here when it comes to tax effectiveness, all right? So, and our cash flow. Over time, we want to, the tax effective, let's talk about tax and let's talk about lending, all right? So the two main things, well, if we swap them around, actually, because when it comes to buying real estate, buying and owning and keeping property as an investment, lending and tax deductions are two vital things, folks. So this is your acquisition stage. You guys have seen this before: acquisition, consolidation, and lifestyle, right? Lifestyle. So in the beginning, in the acquisition stage, when we talk about lending and tax deductions, folks, we're looking to maximize our lending. So what percentage, tell me in the chat here, I'll move it along pretty quickly because this is a bit of a detailed chat today. When you're acquiring, when you're buying real estate, what type of lending do you want, right? Now, talk about loan to value ratios and interest rates, okay? So chuck it in the chat for me right now. Loan to value ratio, you want to maximize your loan to value ratio. Now, you guys know that there's a little sweet spot at sort of 88%, but let's call it 88 to 90%, right? Simple and fast. Exactly, Tim. Yep, simple and fast today. Well, we'll try to do that anyway. So loan to value ratio, 88 to 90%, and you want the lowest interest rate, okay? So you want interest rate to be, interest only, and you want it to be the lowest one you can get, right? Now, the challenge is, folks, in the beginning, what do you want with your tax deductions? You want the tax deductions to allow you to use depreciation and other losses against your personal income, all right? Personal income. So you want two things. 1, 2, okay, in the beginning. Now, let's say later on over here in lifestyle, folks, loan to value ratio, when we're talking, lending and tax, right? Tax deductions, lending, well, over here, you don't really care, 80% or less, 80% or less. And, the percentage, and when you're borrowing below 80%, it gets cheaper, it gets easier, et cetera, et cetera. And number 2, later on in life, folks, what type of tax minimization do you want? Like, tell me, what's the major tax minimization over here in lifestyle lending, or even in the consolidation stage, to be honest? What type of tax minimization are you looking for when it comes to later in life, right? Later in life. At some point when you say, all right, that's it, I've had enough of going to work every day. Maybe I'm going to cut back. Maybe I'm going to minimize my time. And, 1 or 2 days a week, I'm going to, retire myself. That's right. Capital gains. So CGT and also income, right? But what do you want to do with it particularly, folks? You want to be able to split or divide the income. Okay, so there's these two opposing pieces when it comes to our world of property investing. We want to have our tax minimization up here. All right, we want to have our depreciation, our losses on our personal income, and we want to be able to, yep, that's right, allocate income, Tim. And then over here, when we borrow, we don't really mind about the loan to value ratio. That's fine because we're well below 80% anyway. It's paid itself off most likely if you own it for long enough. But capital gains tax and splitting income, okay? Splitting income. So this is the challenge. This is the conundrum. What do we do in here? All right, so let's talk about that. That's kind of set it up a little bit. We'll talk about some of the bits and pieces at the beginning. All right, so as individuals, how can we do that? There's 2 ways you can own as a single individual. You can own as joint tenants in common, or you can joint tenants, or you can own as tenants in common. All right, in common. There's 3 ways as an individual, or not using structures team, not using structures, that you can own the property. I think I need to have put an L in there, single, or an individual single person. So this is 3 ways you can own this real estate. So number 1, as an individual person, you can get the loan to value ratios that are high. You can get the cheaper percentages, depreciation and losses. You can offset that against your personal income. So you can offsets and you can get your tax deductions back on your personal income. And it's 100% you, obviously. Now, as an individual, later on, what happens is you have to declare 100% of the income because it's yours. You can't split it. Okay, so that's a bit of a bummer. But you do get the capital gains tax deduction of 50% at this point in time. All right, so we're good with that. Okay, let's move these ones down. Joint tenants in common. What's the difference between joint and tenants in common? Joint tenants and tenants in common. Just quickly, let me quickly explain what that means. Wait till my little pencil here gets joint tenants. Joint tenants is what we would call a family arrangement. A family arrangement, which means, like, basically a family arrangement, 2 people own the property together, and if one passes away, it goes to the other person. Okay, that's in automatic. So if 2 own it, if one passes, it automatically goes to the other person. Okay, that's the basics of joint tenants. Now, again, joint tenants is fine. You can get your lending, which is good. You can get your offsets and you can get your tax deductions, which I like. It's good, right? Tenants in common. It's more like a business arrangement, okay? And there's a percentage of the ownership of the real estate. And it doesn't have to be the same. It could be 10-90. It could be 50-50. It could be whatever, right? But again, and what happens if someone passes away, that percentage is owned by that other person's estate, et cetera, et cetera. It's dealt with in the will, okay? Now, getting a bit complicated here, so stick with me, all right? But again, yes, you can do loan to value ratios, you can do offsets and personal, you can do, the capital gains, tax-free discounts, et cetera, et cetera. My preference for you, if you are PAYG, if you are an employed investor, is that you stick with one of these 3 ways of owning your real estate, right? This is my tick right here, because it's easy to get lending, easy loans. You get your tax deductions from your income, which is perfect. Plus you get 50% deductions and so on. All right. Later on, if we want to, we can use some maneuvers to transfer some wealth into other lower income places. Okay. That's my preference for you guys when it comes to the world of property investing. Why don't we use company and trust structures? The majority, if you're in business, if you're a business owner right now, then they can be very useful. So if you're a business owner, and your turnover is more than $1 million, and you're making more than $300,000 a year in profit, okay, after you pay yourself, then structures, big tick in the box for you, all right, business owners, okay? But for PAYG, structures have limited appeal in the beginning, okay? Limited appeal in the beginning. And so why? Why do structures have limited appeal in the beginning? Well, any company trust structure, the loan to value ratio struggles to get over 90%. 80% is the norm, okay? You have to put more money in. And the interest rate is often higher okay? Especially if you're not offering other security, folks, which is like, other properties and stuff like that. When you want standalone security, standalone borrowing and stuff like that. And the big one, folks, what's the big one? Does anyone know the big one when it comes to owning properties as a PAYG in company and trust structures? The big one is that your tax losses, right? Losses get trapped in the structure. In the structure. What does that mean? It makes properties negative cash flow for you. Okay, stays in the structure. Exactly, Tim. Now, if you can't get income into this structure, where business owners, if they set their structures up right, can get money from their trading entities over into their asset ownership, right? A PAYG, it's very difficult, if not impossible, to get cash from your job into this company trust structure. Well, it's not possible as a PAYG employee. Then the tax losses get trapped inside there, and then you have to deal with that property pre-tax cash flow. You're putting the money in, plus it costs you money, let's say $2,000 to $3,000 a year to do the taxes. It can be quite negative cash flow to own a property in a company trust structure. Okay, and for PAYG, that can be the problem that can stop you from wanting to own those properties. Well, you need to understand the cash flow on that, right, as we go. Hopefully that makes sense. I didn't get a lot of time to dive into the detail of it today. One structure that works for many people is a self-managed super fund. That's actually just a simple company trust structure as well. That is quite effective, but its tax rate, it's taxed differently. So, some people choose to work with those. All right. So the takeaway, team, for most of us, if you are PAYG and you want to understand, ownership as an individual or an individual. Yeah, that's right, Tim. If you own really high cash flow properties, then they might be worth owning in a company trust structure. You're right about that. But there's three ways you can, as an individual, manage some of the risk or the problems if you want to. Okay, if you are owning the property as a person, individual, how can you manage the risk? All right. So number one, you can manage the risk through the lending or the loans. Number two, you manage the risk through insurance. Make sure you got it. And number three, you make sure you have a good property manager. Okay, that's the three ways you can manage risk and minimize any challenges or problems when it comes to owning properties as an individual. Anyway, I might dive a bit deeper into that one in the next few days. But there you go. My preference for you is that unless there is a really important reason that you're exposed to, significant amounts of risk, then you manage your risk in that way: the loans, the insurance, and the property manager. All right, that's it. I think I've gone over time today. It was a bit bigger than I thought, today's conversation, but there you go, folks. Wealth Coffee Chat done and dusted. Hopefully that was useful. Let me know in the chat if there's something that you want me to chat about through one of these chats, during the morning chats. Yeah, there you go. Anyway, yeah, lending and servicing, exactly, Tim. Yeah, there's so much in this conversation, folks. It's pretty important to sort of get the gist of. Anyway, there you go. Wealth Coffee Chat done and dusted, team. Join me tomorrow for another one if you're up for it. Let me know in the chat if there's something you want me to talk about, like I said before. And yeah, that's it. We're done. See you, folks. Have a good one. Bye-bye.